Hello, my dear friends. I'm back. Mark the Mazel is back, and we're gonna pick up where we left off, which is investing. I really missed making videos for you guys. I've not been investing much the past 2 years with the problems I had in Kenya, and then of course my family that's expanding and yeah, ladies and babies, my God, that takes time, huh? But it's also beautiful, and I've come to realize that my priorities is wrong, that I should actually work less for money and work more for my relationships that were not going so well and are going better now. Um, but I've neglected my investments. I've done poorly. The last videos I've made was 2022. I think the middle of 2022 maybe. Um, no, it was towards the end and early 2023 still. Um, actually, and the stock market had fully corrected, and I was bullish. That was the right call. Um, the market did go up. However, I was wrong the year before. I was bullish the whole year of 2022, the whole way down. And my portfolio was positioned as such, and I had the biggest loss ever, losing 92% from the top in 2021 of my portfolio. And I've never been so wrong in my investment career. And also my positions were absolutely wrong, all of them. Also the hedges that I had put on were wrong. So I did very poorly, but I was also very much distracted by the problems with the corrupt Kenyan government that attacked me and my family, making false accusations of money laundering, sending money from my account to my girlfriend's accounts as a gift. They call that money laundering. How can you launder money that way? It was never explained in the court cases. Still, some of these cases are still ongoing. Some have been dropped. But yeah, I learned a few lessons about how Africa works. But yeah, where are we with the investments? Huh? I did poorly this year, 2023. From the low, I'm up only 30% or so. Not much. And I'm still about 40% crypto. I had a big allocation in growth stocks, also around 30-40%. And then some commodities, uranium, 10%, 20%. And that's my portfolio. But I sold actually quite early during the rally, but a little bit before the top this year. I sold my growth stocks, most of them. I kept 10%, but I sold 30% exposures to growth stocks. That was cash and is still cash today, and I need to invest it in something. So that's what I'm focused on. My 40% crypto allocation is okay. I have a 10% uranium exposure that went up a bit. But other than that, I just have 30% cash. And the question is, what will I do with that? I'm forgetting something because there's a gap there. Let me think about it. So I just checked my portfolio. The growth stocks are still a little bit bigger, 18%. That's a hedge fund I'm invested in that is mainly in Tesla calls. So yeah, risky investment. Huh? I had a very bad experience with options, yeah. But this person that runs a hedge fund has done very well for himself and for the fund the past few years, using call options in Tesla. But of course, Tesla is already more than fairly valued, I would say. Yes, it's a great company, but it's already fairly valued. Even I would say, is it overvalued? That I can't say, but it's certainly fairly valued. It's not undervalued. Um, so, would I recommend this investment to other people? I'm considering taking some money off the table actually, because of the high risk of such a hedge fund. Um, Crypto, yes, 40% crypto, 42, mainly Ethereum, a little bit of Bitcoin Cash, and that's it. And yeah, I think that's an okay investment. Ethereum is, or crypto in general is 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 also not overvalued, I would say. It was worth 3 trillion a year ago or so, or 2 years ago. Now it's worth 1 trillion. Compared to the other assets in the world, it is not overvalued, but it is also not really undervalued that much neither, I would say. Although if you follow the Kelly criterion, I know the logarithmic regression at Trololo chart, it is actually undervalued by 50% compared to its historical growth rate, and so it should be actually worth 2 trillion today, not 1 trillion. And I think that's one of the best tools to judge the valuation of crypto. So actually there I have to say that yes, crypto is undervalued, and so to have my largest exposure to crypto, I think is correct, is good. And then uranium, I have a 10-12% exposure. I think that's an okay investment because it's just it's, of course, you're just investing in a commodity. You're not investing in the next generation of nuclear reactors, which would be a better investment, but that's just not possible to do. But the commodity uranium likely will go up because of an increased demand. Like the idea was in the West to shut down nuclear reactors. Now they're changing, luckily, their mind, and they keep them open, and that means that they need to order more uranium that they have not ordered. For example, in Belgium, that's the case, and I guess that's also the case in other countries, and of course, uranium, like gold, the past few years has not seen its supply go up, which is an important metric I'm keeping an eye on if you want to judge whether there will be a shortage of a certain commodity. A very good indicator is to look at production, the mining production. And if the mining production lags or goes down or stays flat while the demand continues to go up, then that will lead to a shortage. And so if you see that indeed production goes sideways or down, that's a good indicator that actually there will likely be a shortage in the future, and so it's a good investment, and the price should go up. Because why is it that the supply goes sideways or down? Usually it is because the price is not high enough. However, I have contested that with gold. A year or 2 years ago, I was bearish on gold. I was short gold, at calls on gold. I thought it would go down, and I was wrong. 2 years later, gold is still at the same relatively high price. What I said at the time was that gold production is indeed not going up, it's going sideways, and that's a bullish for gold. But I said that's probably because of the COVID restrictions, the red tape that caused many miners to not produce due to a shortage of labor or due to supply chain problems, and so we'll have to wait and see how that goes. Um, but and the same actually I said about uranium, where the leading producer in Kazakhstan artificially reduced its mining capacity to raise the price. No, they didn't say to raise the price, they said to preserve their reserves. But to that I critiqued that will not work. If the price is high enough, others will pick up the slack, and uranium production will continue to go up, and the leading producer will just lose market share. And I have not checked actually the production numbers for uranium. I haven't checked it recently, and for gold, but I suspect it's still going sideways. But COVID is long past. Supply restrictions have been resolved already for almost 2 years. Like production should really go up for uranium as well as gold, if indeed the price is considerably above the production cost. But that doesn't seem to happen, so that's a bullish argument. But please point it out to me if I'm wrong. If indeed production is going up considerably for either uranium or gold, I would like to know that, because that's bearish. But it doesn't look like that's the case. Something else that has come to my attention lately is thanks to the work of Felix Zulauf. I am subscribed to his expensive reports. He's bearish on the stock market, but he does make a very good case that China is extremely overvalued, the real estate in China. And the bubble is bigger there from the statistics I've seen in his reports than the bubble that was in Japan in the 80s, and many other real estate bubbles. For example, the rental income of a property in many Chinese cities is only 2%. 1 to 2% is the rental income of a property. That's indeed very low. For example, in Europe, it's around 3-4%. In mainland Europe, I think in England, in London, it's a bit higher, 4 to 5% rental income, and of course that's gross rental income. You have to, of course, include taxes also, but taxes are not high. Maybe you will pay 0.5% per year on taxes. So the gross rental income is almost the same as the net rental income. And so that's how you can look at basically the dividend yield of a property, or the returns of a property, and how high it is valued versus its income that it generates. This is a very important metric for me. In the United States, I've noticed that this can be a lot higher. You can be even be at 10%, but the taxes are extremely high also there. Like, I was so surprised to see that in certain regions in the United States, you can have a property tax of 5% per year, not 0.5%. Not 2%, but 4% or 5%. That's crazy. So then, but then gross rental income is also considerably higher. It's maybe 7% or 8%. But if you deduct the taxes, then there's only 3% left or 2% left, and then that's considerably less than in all the other examples I gave. But of course, the bigger picture here is that what will really interest rates do? My opinion is that interest rates have gone down for 40 years, since 1980 till 2020, and will likely go up for the next 40 years, but slowly and steadily. Not slowly and steadily, but with a zigzag movement, and now we're in the short term were too high. It will likely correct from 5% back to 3% or so. But in the long term, it's probably going to go up over the next 40 years, interest rates. And so how will that affect real estate in general? Badly. There is a good counter argument to say here is that in the 70s you had a rising real estate also, but many actually in most of the West real estate went up a lot despite the interest rates going up from 4% to 12% or from 3% to 10% during the 70s. Real estate price went up a lot also during that time. How is that possible? Well, that was possible because actually real estate was a lot cheaper at the time. If you compare to the household income, a property could be bought for somewhere around 3 times annual income, 5 times annual income. But today we're at 10 times the average annual income, or 15 times. And so we're a lot higher today than we were at the early 70s. And it would be the same as saying today, like, let's say a property costs $300,000 today, and you have interest rates will go up, but annual income typically, or in a region where you pay $300,000 for a condo, what will be the average annual income of a person? Probably 30,000 or so US dollars. So that's 10 times the annual income, the price of the property. If then interest rates go up and mortgages become a lot more expensive, then real estate prices likely will come down. However, if the annual income would not be, average annual income would not be 30,000, but let's say 90,000, then that's a different story, because then real estate is relatively cheap, and even if mortgages become more expensive, that's easily affordable for people because of their relatively high income. But that's not the case today. So I'm generally bearish on real estate because interest rates will likely go up, and also because of population collapse. In the West, you have, thanks to immigration, a continued rising population, but the population itself is not growing enough, and immigration will likely go down because it's just in the West overdone. But if you look at China, it's a disaster. Like, they don't have immigration. The only thing they have is people stop making babies, but there are no immigrants to make up for that. And that really causes population collapse. And in China, the real estate market being valued so high, and at the same time population collapsing, how can that end well? I don't see how that's even possible. Like, it's just not possible. And interest rates worldwide likely to go up over the next 20 years, 30 years, 40 years. Like, it is so likely that Chinese real estate will collapse the same way that it did in Japan, where you also saw population collapse. Japan is the one country that's been ahead of the West in the things that have happened. And yeah, we have seen their real estate go down now for almost 40 years. No, sorry, 30 years. So, like, I think that's what's to come in the West, but especially so in China. So I'm very bearish on that, but I have not found a way how you can profit from that, how you can help the system basically reprice things correctly. Going short is an instrument I don't dare to use anymore, because that means you're borrowing, and it's a bad loan. But the way you could play that is actually go long the inversely correlated asset, which when it comes to stocks is commodities, but when it comes to real estate, I don't know which is the inversely correlated asset, but gold, I think, comes to mind here because well, that's the report I'm hearing is that Chinese, instead of investing in real estate, they start investing in gold. Um, and I do think in general, for me, I am not so sure anymore that over the next, that we're still in a stock bull market. As I've always said before in my work, that look, the stock bull markets, they last on average 20 years, sometimes 30 years, sometimes 10 years, though that's very short and has only happened 100 years ago once. That was at the end of 1800, in 1880 or 1890, had a 10-year stock bull market, or was it also in the early in 1920, you also had a 10-year bull market after World War I, but it only lasted 10 years. After that, it was a bear market in the 1930s. So that was a short bull market. But yeah, you just had a World War before that. But it is very rare to have an only 10-year stock bull market, and that's why I said in my work before that it's not likely that that we're in a bear market. We're going to start a bear market. We just had a bull market in commodities in the 2000s, from 2000 till 2010 or so. Commodity price went up a lot. The production capacity went up a lot of commodities, and we still need to work that off. And therefore commodity prices are likely to continue to go down, and this will be bullish for stocks, likely for another 10 years. That was my thesis before. But I am not so sure about that anymore. What comes to mind is that the valuation of the stock market is actually already relatively high if you look at different metrics, such as they call Buffett indicator. The value of stocks versus GDP is historically high. Actually, this is the one indicator that I really regret I did not pay more attention to in 2021. I was of the opinion that there was excess in the market, that the stock market would likely correct, and I shared that. But at the same time, I was still very convinced it would be just a short correction, and after that we continue to go up. But later, when I realized, Jesus, I was so wrong about this short correction. It corrected harder and longer than I thought, and I was completely wrong with crypto, thinking that the top is not in yet. But it was actually in and continued to go down with the stock market very hard. I studied what did I overlook, and this was the indicator that really stood out to me, is that the valuation of stocks was historically high, and it is certainly possible from that perspective that that we get a long bear market in stocks. And if I look at that's one argument. Another argument is wars. If we get war, and we are in a war now with Russia, the West with Russia, that's also not good for the stock market, and it's better for commodities. There's a shortage of commodities. There's money printing, but there's a shortage of commodities because they want to wage war, and for that you need commodities, and people will spend less money on consumer goods, and so that's bad for stocks. And so yeah, that's why, like, I want to build out a bigger position towards commodities in my portfolio, even though that could be the wrong investment. like I just want to change my portfolio strategy a little bit, in that I do not want to take such high risks anymore of betting everything on one scenario, um, um, because if you're wrong you lose so much. I do want to bet on different scenarios, but I want to try to avoid a hedging strategy where one wins, the other one loses, which is the permanent portfolio. I don't want to do that. What I do want to do is I want to have several great investments, but that are not correlated. And that's why I am tempted today, for example, for my cash to invest it in a bigger exposure of crypto, or a bigger exposure towards growth stocks again. But that's what I always did in the past. I would be like 80% exposed towards this growth scenario, and that would play out very well then if I'm right. But yeah, I was wrong about that a year ago, 2 years ago, and then you lose a lot. So I would prefer to instead have smaller positions, but on different things, and that are not per se correlated. And that's why I'm attracted, for example, look for a way how I can profit from the overvalued Chinese real estate market. But the only instrument I can come up with is going long commodities, going long gold, and but I'm not so sure that's the right bet here. So if you have any feedback about that, I'm always interested to hear. That's it, guys. Thank you so much for checking out my video, and very nice to see you again. I hope that I can make more videos again, and yeah, I've come to realize these videos and sharing my work on Twitter, it helps me a lot in becoming a better investor, and so I value your feedback very much. Have a good day.